Ever wondered if there's a secret to predicting the market's every twist and turn? What if I told you that the answer, or at least a significant part of it, might lie in the very principles that govern the universe? No, I'm not talking about mystic prophecies or crystal balls. I'm talking about something far more profound, something rooted in the mind of one of history's greatest intellects, Sir Isaac Newton. For centuries, the financial markets have baffled investors, swinging wildly between euphoria and despair. We chase the highs, panic at the lows, and constantly hear the age-old adage, "You can't time the market." But what if that's not entirely true? What if, by understanding the fundamental forces that Newton so brilliantly articulated, we could gain a unique perspective, a different lens through which to view the ebb and flow of capital? This isn't about magical indicators or guaranteed returns. It's about a paradigm shift. It's about applying a Newtonian framework to financial analysis, not to predict the exact price of a stock next Tuesday, but to understand the underlying dynamics, the gravity and momentum that drive market behavior. We're going to explore how principles like inertia, action-reaction, and even the law of universal gravitation can offer powerful analogies and insights into market timing. Think about it. Newton's laws describe how objects move in the physical world. Markets, too, are systems in motion, driven by the collective actions of millions of participants. Just as a falling apple is subject to gravity, so too are asset prices subject to forces of supply and demand. Just as a body in motion tends to stay in motion, so too do trends in the market tend to persist. Now, before you scoff and say, "This sounds like a physics lecture, not investment advice," hear me out. We're not going to be calculating planetary orbits to pick stocks. Instead, we'll be extracting the core philosophical and mechanical principles from Newton's work and translating them into actionable market insights. This is about building a robust mental model, a framework that transcends fleeting news cycles and allows you to see the bigger picture. Let's dive into Newton's first law, the law of inertia. This states that an object at rest stays at rest, and an object in motion stays in motion with the same speed and in the same direction unless acted upon by an unbalanced force. How does this translate to the markets? Think about trends. A strong uptrend, much like a body in motion, tends to continue in that direction unless a significant force acts upon it. That unbalanced force could be a major economic shift, a geopolitical event, or a drastic change in corporate fundamentals. Applying this, a Newtonian investor would recognize that fighting an established trend is often futile. If a stock is consistently moving upwards, its inertia is in that direction. Shorting it aggressively without a clear, strong counterforce emerging is like trying to stop a freight train with your bare hands. Conversely, if a market is stagnant, showing little movement, its inertia is towards remaining at rest. Trying to force a trade in such a market might be premature. You're waiting for the unbalanced force to initiate new momentum. This understanding of inertia isn't about blindly following trends. It's about recognizing their inherent strength and the energy required to change their course. It encourages patience, waiting for confirmation of a new force before making a significant move against the established direction. It's about asking, what is the dominant force currently acting on this market, and how strong is its momentum? Next, let's consider Newton's second law, force equals mass times acceleration, F equals ma. While we're not dealing with physical mass, we can interpret mass in the market as the sheer volume of capital or the collective conviction behind a particular asset. Acceleration is the speed and intensity of price movement. A large amount of capital, mass, flowing into an asset with increasing speed, acceleration, indicates a very strong force driving prices higher. This law provides a powerful analogy for understanding the strength of market moves. A small amount of buying volume causing a large price spike might indicate a weak force, perhaps a low mass of conviction. But a massive inflow of capital leading to a sustained and rapid price increase suggests a significant force at play. For timing the market, this means paying attention not just to price changes, but also to the volume behind those changes. High volume on a breakout suggests a powerful force initiating a new move, making it a potentially good entry point. Conversely, a price decline on low volume might indicate a lack of strong selling pressure, meaning the force to push prices down is weak, and a rebound could be imminent. It's about discerning the conviction and capital behind the moves. Then we come to Newton's third law: for every action, there is an equal and opposite reaction. This is perhaps one of the most profound and often overlooked principles when applied to financial markets. Think about overbought and oversold conditions. When a stock skyrockets parabolically, action, the reaction is often a sharp correction or consolidation. The further an action extends, the more potent the inevitable reaction tends to be. Consider the concept of mean reversion. Markets tend to pull back towards their averages. A stock that has moved significantly above its historical mean price is experiencing an action of extreme buying. The reaction is often a pullback towards that mean. Similarly, a stock that has been heavily beaten down, action, often experiences a strong rebound, reaction. This law also applies to sentiment. Extreme optimism, action, often precedes a market top and a subsequent correction, reaction. Extreme pessimism, action, often signals a market bottom and a subsequent rally, reaction. The Newtonian investor understands that exuberance and panic are not sustainable states; they are actions that inherently trigger powerful reactions. For timing, this means looking for extremes. When everyone is euphoric and buying indiscriminately, that's the action signaling an impending reaction of selling. When fear is pervasive and people are capitulating, that's the action signaling an impending reaction of buying. It encourages a contrarian perspective, not for the sake of being contrarian, but because the universe demands balance. Beyond the three laws of motion, let's consider the concept of universal gravitation. Newton showed that every particle attracts every other particle with a force that is proportional to the product of their masses and inversely proportional to the square of the distance between their centers. While a direct translation to markets is complex, the analogy is powerful. Think of mass as the collective value or importance of an asset or sector. Larger, more established companies or sectors often exert a greater gravitational pull on capital. They are more stable and tend to attract more investment over the long term. Smaller, speculative assets, while capable of rapid acceleration, might have less gravitational pull, making them more susceptible to sudden shifts. With that said, thanks for watching, and until next time.